What did I tell you would happen when tensions escalate in the Middle East? Silver doesn't ask permission, it just moves. We were sitting at $72 per ounce 3 days ago. Then Trump issued the warning to Iran. Silver exploded $5 higher in 48 hours. $77 Western spot, 77 futures. Shanghai trading 86 spot, 88 futures. $9 premium in China. That's not a spread. That's panic buying. Oil up 4%. Crude hasn't moved like this since the Ukraine invasion kicked off. Gold pushing 5,000. Bitcoin dropping as risk-off rotation accelerates. This isn't coincidence, this is the sequence. The same sequence that has played out 3 times in recorded history. Same pattern, same sequence, same outcome. Every single time an empire reaches maximum debt saturation, debases its currency beyond recognition, and enters a resource war to maintain control, the metal moves first. Not the stock market, not the bond market, the metal, because the metal knows. It always knows before the people do. Let me show you the pattern. Rome, 3rd century. Empire stretched too thin. Military spending out of control. Tax revenue couldn't cover the legions anymore. So what did they do? They started clipping coins. Silver denarius that used to be 95% pure silver got debased down to 5%. They mixed in copper, bronze, whatever they could find. Told the people it was the same money. It wasn't. Prices exploded. Bread that cost a denarii suddenly cost 200. The soldiers refused to fight because their pay was worthless. Barbarians started sacking the borders. Within 50 years, the Western Empire collapsed. Not because of the barbarians, because of the currency. Verified. Dutch Empire, 1700s. Controlled global trade. Had the reserve currency of the world, the guilder. Then they got into a series of wars with France, with Britain, with Spain. Wars are expensive. Really expensive. They started printing, they started borrowing. Debt to GDP went over 200%. The guilder lost reserve status. Trade routes got cut off. Within 30 years, the Dutch went from the richest nation on earth to a secondary power. They never recovered that status, ever. Verified. British Empire. 1914 to 1945. Pound sterling was the global reserve currency for over a century. Then World War I happened. They borrowed massively. Promised to pay it back in gold. Couldn't. Suspended gold standard. World War II finished the job. Britain ended the war with debt over 250% of GDP. The pound lost reserve currency status to the dollar in 1944 at Bretton Woods. Britain never regained dominance. Verified. 3 empires, 3 collapses, same sequence every time. Overextension, debt explosion, currency debasement, resource war collapse. You can argue about the details, you can argue about the timeline, you cannot argue about the pattern. It is mathematical certainty. Now let me show you where we are right now. US national debt, $36 trillion. Congressional Budget Office just released new projections. Debt will hit $64 trillion in the next 10 years. That is not a typo, $64 trillion. That means we are adding roughly $2.4 to $2.5 trillion in new debt every single year for the next decade. Even if there is no recession. Even if there is no war. Even if there is no emergency spending. Just baseline spending. Interest payments on that debt are already over $1 trillion per year within 5 years. Interest costs alone will exceed the entire defense budget. Think about that. We will be spending more money paying interest on old debt than we spend on the entire military. And that is assuming interest rates stay where they are. If rates go up even 1%, those interest costs explode to $1.5 trillion. Then $2 trillion. At that point, the majority of tax revenue goes to paying interest, not roads, not schools, not defense, just interest on past borrowing. Debt held by the public is projected to go from 101% of GDP this year to 120% by 2036. That would be the highest debt to GDP ratio in American history, surpassing even World War II. But here is the difference. In the 1940s, that debt was accumulated fighting an existential war. We won. We rebuilt. The economy boomed. Debt came down. This time, we are accumulating peacetime debt. We are not building anything. We are not winning anything. We are just spending. Spending on entitlements. Spending on interest. Spending on programs that do not generate growth. This is not sustainable. It is not a political opinion. It is arithmetic. Now, add the currency piece. Since the Federal Reserve was created in 1913, the US dollar has lost over 98% of its purchasing power. What costs $1 in 1913 costs $34 today. That is official CPI data, which we all know understates real inflation. Your grandparents could buy a house for $15,000. That same house today is $600,000. Same house, different currency. The dollar didn't hold value. It bled value. And the bleeding is accelerating. M2 money supply, which is the measure of total dollars in the system, exploded from 15 trillion in 2020 to 21 trillion by 2022. They printed $6 trillion in 2 years. 6 trillion. Then they tried to pull some of it back by raising rates and doing quantitative tightening, but the money is still out there. It is in the system. It is in asset prices. It is in real estate. It is in stocks. And now they're about to start cutting rates again. FOMC minutes released yesterday confirmed rate cuts are coming. Several officials said cuts would likely be appropriate if inflation keeps declining. Translation: they are going to start easing again. More liquidity, more currency debasement, and the metal is already moving in anticipation. Silver up $5 in 2 days. Gold at 5,000. Not might happen, already happening. Now let me show you the resource war component. Trump just issued a direct warning to Iran. He said if Iran does not agree to a deal, the US may have to utilize military bases in Diego Garcia and the UK. He warned that an attack originating from Iran could potentially strike the UK as well as other allied nations. In response, the US Air Force is deploying an additional 12 F-15 fighter jets to the Middle East. Crude oil up over 4% on the news. This is not posturing anymore. This is positioning. Officials have previously stated that if military action is launched against Iran, it would not be a limited strike. It would escalate into a large-scale, weeks-long war. 20% of the world's oil flows through the Strait of Hormuz. 20%. If that choke point gets shut down, even for a few days, oil prices double, maybe triple. That means gasoline at $8, $9, $10 a gallon in the US. Diesel goes even higher. Trucks stop moving. Shelves go empty. Food prices spike. This is not fear-mongering. This is supply chain reality. When energy costs double, everything that moves, everything that is grown, everything that is manufactured becomes more expensive, instantly. And if the conflict lasts weeks, which officials are now saying it could, we are talking about a global energy crisis worse than the 1970s oil embargo, worse than the Russian supply shock in 2022. And it is happening at the exact moment when the US dollar is already losing purchasing power and the national debt is already spiraling out of control. Same pattern, same sequence, same outcome. Let me show you what is happening in the silver market specifically, because this is where the story gets really interesting. 3.4 million ounces of silver were pulled out of COMEX vaults on Tuesday alone. Registered silver, the silver that is available to settle futures contracts, dropped below 90 million ounces for the first time in years. It is now sitting at 88.8 million ounces. Almost every single vault was raided. 2 million ounces withdrawn from JP Morgan. 587,000 adjusted out of HSBC registered. 345,000 adjusted out of Brinks registered. Over 900,000 withdrawn from other vaults. This is not normal. Registered silver is supposed to sit there. It is supposed to be stable inventory backing the futures market. When it starts disappearing at this velocity, it means someone is taking physical delivery and removing it from the system entirely. And this is happening right before March contract settlement, which begins in days. There is still a massive open interest that has not rolled forward, meaning a lot of contract holders are planning to stand for delivery. They want the physical metal. If this continues, COMEX will not have enough registered silver to settle all the contracts. That has never happened in modern history. If it does happen, the paper price becomes irrelevant because there is no metal to back it. Price discovery moves to the physical market, and in the physical market silver is already trading at massive premiums. Shanghai spot is 86, futures 88. Western spot 77, that is a $9 premium in China. $9. That means Chinese buyers are paying 12% more than Western buyers just to get the physical metal. Why? Because China knows what is coming. Shanghai Futures Exchange just declared war on paper silver, effective February 27th. They are implementing a major rule change designed to protect China's critically low physical stockpiles. Here is what the rule does. Hedging positions in the delivery month and the month before are automatically set to zero contracts, unless you have a pre-approved special hedging quota. Only genuine industrial hedgers with explicit approval can hold positions right up to delivery. Speculative longs or non-approved positions must roll out earlier or close. This slashes pressure on immediate physical deliveries. Why are they doing this? Because Shanghai Futures Exchange registered silver stocks have plunged under 350 tons. That is the lowest level in over a decade, down 88% from the peak in 2021. The exchange is in extreme backwardation, meaning nearby contracts trade way more expensive than distant ones. That is a screaming signal of urgent physical demand. China is locking down the scarce metal to prioritize domestic industry before inventories run completely dry. This accelerates the shift. Paper manipulation loses its grip as physical control moves east. The West still thinks it can control price with paper contracts. The East is taking the physical metal and walking away. You cannot unsee this once you see it. The paper market is dying. The physical market is taking over. Now add this. Silver rally continued after U.S. critical minerals price floor plan details leaked. The government is implementing a price floor mechanism for strategic metals including silver. What does that mean? It means silver producers will not be forced to sell at fake suppressed prices anymore. If the paper market tries to crash silver below production costs, the government will step in and buy at the floor price. This removes the primary weapon that has been used to suppress silver for decades. Slam the paper price. Force miners to sell at a loss. Keep physical prices low. That playbook is over. The US government just admitted that silver is a critical strategic metal and they will not allow it to be crashed below a certain price. This is massive. And the market knows it. Silver is up $5 from the lows. We hit 77 on this news. And here is the best part. We got so used to systematic slamming multiple times daily that not seeing a single slam for over 12 hours starts feeling awkward. Normally, 9:30 a.m. Eastern is slammy time. The COMEX opens and silver gets hit every single day. Tuesday, 9:30 a.m. hit and COMEX sends silver up. Up there nervous. Because the masses just found out that silver producers are not selling at fake prices anymore. The suppression mechanism is breaking. Not opinion, pattern recognition. Let me show you the bigger picture. Global uncertainty just hit the highest level in recorded history according to the IMF Uncertainty Index. This index measures global fear by scanning economic reports across 143 countries and tracking how often the word uncertainty appears. For perspective, September 11th and the Iraq War barely show up on this scale. COVID in 2020 caused what was then the worst spike ever, hitting around 60,000 on the index. The current reading is nearly double that. We are at 120,000. The main drivers are the escalating global trade war, the massive wave of tariffs being implemented, geopolitical conflicts in Ukraine and the Middle East, and growing doubts about Federal Reserve independence. When uncertainty hits this level, businesses freeze. They stop hiring. They delay building new factories. They shelf expansion plans. They sit on cash. Capital expenditure drops. Growth slows. Recession risk rises. And in that environment, hard assets outperform gold, silver, land, commodities. Because businesses and individuals start asking the same question. What holds value when everything else is uncertain? The answer has been the same for 5,000 years. The metal. Here is what fascinates me. Silver allocation as a percentage of global wealth is currently 0.03%. In 2011, it was 0.06%. We are at half the allocation level we were at during the last precious metals bull market. That is not a bubble. That is neglect. Silver is not overcrowded. It is barely owned. In 2011, the S&P was still below its 2007 peak. After years of sideways equity markets, investors looked elsewhere. They rotated into commodities. They rotated into metals. Today, equities are near all-time highs again, while silver allocation sits at half of 2011 levels. What is even more interesting is 1980 allocation. After 14 years of a sideways tower from 1966 to 1980, silver allocation must have been far higher than 0.06%. If we knew that number, we would have a better framework for how long this cycle can actually run, but we do not have that data. What we do know is this. Institutional capital is massively underweight precious metals. Pension funds, endowments, sovereign wealth funds, they are all overweight equities and bonds. When the rotation happens, and it is happening right now, the move will be explosive. Because there is not enough metal to absorb that much capital. 3 million ounces pulled from COMEX in one day. Registered inventories down to 88 million. If even a small percentage of institutional capital tries to get physical exposure, there will not be enough supply. Price will have to go much higher to ration the available metal. Gold is back at 5,000, silver 77. When gold first broke 5,000 a few weeks ago, silver broke 100. Then it pulled back. Now gold is back at 5,000 and silver is only at 77. That means silver is insanely cheap on a gold to silver ratio basis. The ratio is currently around 65:1, meaning it takes 65 ounces of silver to buy 1 ounce of gold. Historical average is somewhere between 50 and 60. During peak fear, that ratio can compress to 30 or even lower. In 2011, it briefly touched 32. If we get back to a 50:1 ratio with gold at 5,000, silver goes to 100. If we compress to 40:1, silver goes to 125. If we hit 30:1 in a panic, silver goes to 166. And we are starting from 77. That is not hopium, that is math. The ratio always compresses during crisis. Always. We are not at the cliff. We have already walked off it. The question is not if the collapse happens. The question is how far we fall and how fast. Let me paint the picture of what this looks like for a normal person. You wake up and check your phone. News alert. The US launches airstrikes on Iranian nuclear facilities. Iran closes the Strait of Hormuz. Oil jumps $20 overnight. By the time you reach the gas station, prices are already up $2 a gallon. Filling up costs $90. At the grocery store, shelves are half empty. Diesel is too expensive for trucks to run normally. The food that's left has yellow stickers. New prices. Milk is $9 a gallon. Eggs are 12 a dozen. Ground beef is 18 a pound. Your card costs $180 for what used to cost 70. Your bank balance hasn't changed, but it buys half as much. You turn on the news. Officials say they're stabilizing markets. The Fed stands ready. Don't panic. But your neighbor just got laid off. Your 401,000 is down 15%. Your credit card rate jumps to 23%. And you realize this isn't temporary. This is the new normal. Now look at the other side. The people who prepared, they bought silver at 25, gold at 1800. They own land and hard assets. When the currency loses value, their assets don't. They rise. This isn't luck or timing. It's pattern recognition. When empires crack, wealth doesn't disappear. It transfers. And it's happening right now.